It's great pleasure that I am actually able to say that New Zealand's financial system remains sound. The banking system holds sufficient capital and liquidity, which creates a very good buffer for unanticipated shocks, which can unsettle the banking system. I'd like to also say that these buffers, both liquidity and capital, have been guided by our own prudential regulatory requirements. An ongoing driver of financial soundness is the conduct and culture of banks and insurance companies, and these features are being at the moment jointly reviewed by both the Financial Markets Authority and ourselves. It's work in progress, and we do want to keep our findings in the public arena as we have done the work on the way through. We are meeting, as is well known, with the Parliamentary Financial Expenditure Committee later this afternoon with the Financial Markets Authority, so I think it's useful if we keep most of the questions for that forum, particularly when we have Rob Everett with us, the Financial Markets Authority CEO. In terms of the financial system vulnerabilities, we do see them as being very much the same as when Bernard and team last produced the Financial Stability Report. In particular, household mortgage debt remains very high, but this risk has lessened somewhat, and we say that with both lending and house price growth having slowed over the last 12 months. In part, this is due to the imposition of the loan-to-value ratios that the bank imposed on the banking system, the Reserve Bank imposed. We think this more subdued lending growth needs to be further sustained before we have the confidence to further ease the LVR restrictions ahead. So we will continue to watch the credit growth into the housing sector in particular, and the confidence around these more prudent lending behaviours continuing. In a similar vein, the dairy sector remains highly indebted, and the good news is most dairy farms are now cash flow positive, but they remain vulnerable to any price shocks as we've seen in the recent past, and we believe that reducing these financial risks would be a prudent thing to be doing. So we have called on banks to continue their more prudent lending practices that we've observed over the last 6 months or so. The high dairy farm indebtedness and the fact that the bank has had to impose the LVRs really reflects banks' lending decisions. And we believe that some pursuit of short-term profits can lead to vulnerabilities in the longer term. And that is a really key part around the efficiency of the banking sector we'll be looking at, as well as the conduct and consumer, where the consumer sits in our banking reviews that we're doing. I'm now going to hand it over to the Deputy Governor, Geoff Bascand. Geoff, do you want to stand or you?
I'll sit here. Thank you, Governor. So today, late yesterday, we launched the Financial Strength dashboard, and very excited about having done that in terms of making it easier for financial information on banks to be compared. Information such as their capital buffers, non-performing loans, concentration of risk. Our aim is to improve the public's understanding of their bank's financial position and performance, and hence increase the incentives for banks to operate soundly. The banking sector appears to be broadly efficient, although, as mentioned, some lending allocation appears a vulnerability. Major New Zealand banks are in the top quartile of OECD banks for their profitability when we measure that by return on assets. Bank services are widely available and wide-ranging, and they are at reasonable cost. These outcomes are possible in part due to the low cost-to-income ratios of our major banks and the current low levels of impaired loans that improve their profitability. Turning to the insurance sector, as a whole, it also seems sound, profitable and adequately capitalised, again supported by our prudential regulatory requirements. However, some insurers have relatively small capital buffers, which gives them relatively limited scope to meet unexpected or extreme events. we're discussing these situations directly with those insurers. There are also challenges to the efficiency of some parts of the insurance sector. Market shares are concentrated in some areas. Life insurance commissions are particularly high, and this inevitably flows through into higher premiums. We believe technological developments will be a key driver of competition in the future in improving the efficiency of the insurance sector. Ngā mihi, thanks.
Just on the dairy farms, you mention Ambovis as an emerging risk. How big a risk do you think it is? I mean, the coverage and the culling of cattle has been huge.
Given what the government has announced, in terms of dollars per kilogram of milk solid financial impact for farms, it is not that large in the immediate sense. Of course, longer term productivity and all of the other challenges that are already in front of the agricultural sector, it all adds up to vulnerability. But the immediate impact of this, given the government and given the industry's bodies being able to fund in part the 867 million talked about, it comes around to about 15 cents per kilogram of milk solid in terms
That's
of...
right, up to about 15 cents per kilogram.
So a serious impact to farming, not necessarily a serious impact to the banking system.
You cite household debt as New Zealand's largest vulnerability in the report. What impact will rising interest rates overseas have on New Zealand household debt, if that does eventually incur?
Bernard, do you want
Well, of itself, an increase in interest rates, we think the household sector can probably cope with that. The issue really comes about if we get an abrupt change in interest rates, and I guess there are some borrowers out there we know who have relatively high levels of indebtedness, high debt to income multiples. Those are the sort of borrowers who could potentially struggle if interest rates were to move up abruptly, and we talk in this document about the risks that could occur if markets do react dramatically to the tightening in monetary policy that we're seeing around the globe. So that's certainly a risk that we're very conscious of. But the general cyclical lift in interest rates, as long as it's orderly, we think the household sector generally can cope with it.